change is Baillie Gifford's listed equity impact fund. And that means, very simply, we're investing with two equally important objectives. So the first of those is to deliver outperformance over the long run, and we're defining that as 2% ahead of the broad global stock market index, so the MSCI ACWI, over rolling 5-year periods. And then our second objective is to deliver a positive social or environmental impact over the long run again. So we're trying to achieve two things at once, which is a pretty ambitious aim, but something that we feel really passionately about and really strongly plays to our strengths. So let's kind of dig into each of those. We're looking to deliver that outperformance. How are we doing that? Well, let's dig into this a little bit. We've spoken about the outperformance objective. There, we're aiming to invest in a concentrated portfolio of between 20 and 50, so it's currently just under 40 stocks in the fund, of global best ideas. So we can go anywhere to populate this portfolio with stocks. Obviously, it's a long-term equity fund, and we are holding those names for the long term, so this is a low turnover portfolio. And what we're doing is we're very much employing that Baillie Gifford philosophy of finding exceptional growth companies that deliver above average earnings growth over the long run, because we know that if you're patient, share prices follow fundamentals. So very much building on those natural strengths of Baillie Gifford there. And our second objective, to deliver impact, well, we know that that's pretty broad. And so we have defined 4 impact themes through which we're aiming to contribute. So those are social inclusion and education, environment and resource needs, healthcare and quality of life, and base of the pyramid, which is probably the least intuitive of the 4, and that refers to investing to meet the needs of the people who live in poverty in the world today. So, as I mentioned, a really ambitious strategy, but one that we feel very strongly that we can achieve, and we've been running since 2017. So I'll just give you one example of the type of company that we invest in, if that's all right. So we're really excited about a company in our portfolio called Alnylam, which is a pioneering biotech company that has developed new drugs that effectively silence faulty genes, and these have been used to treat diseases for which there has historically been no treatment. And as a result of developing this game-changing technology, Alnylam last year grew its revenues over 80% year on year and delivered its first year of profit. And it has a clear path to sustained growth over the long term. It's delivering treatment for about 500,000 patients today, but actually it has the potential to treat major diseases like hypertension much more effectively than incumbent drugs. So it could be facing into a huge market. So this is the kind of name we're looking for: a fantastic, superior growth opportunity with long-term returns potential, and something that's doing good for the world as well. Well, this is an interesting question, as you would imagine, one that there's been quite a bit of debate about. And I would say over the long run, this strategy has delivered strong performance. It has been a more difficult few years for sustainable and impact strategies as a result of a series of style headwinds. But we absolutely believe and know that impact funds can deliver outperformance, and there are a few reasons for that. The first is that impact, and the way we do it, is quite distinct and separate from broader ESG or ethical investment. So we're only investing in companies whose products and services are impactful and hopefully game-changing. And so for us, there's a very clear alignment there between the growth potential and the impact that a company is delivering. And that may be different to a broader sort of ESG or sustainability approach, which also may look at business practices or the operations of a company. So that very targeted and specific way that we do it. And that also extends to the fact that we're running a very concentrated portfolio here. We have a vast investment universe. There are about 9,000 companies with a market cap of over $1 billion US. And we're only looking to populate a portfolio of between 20 and 50 names, as I mentioned. So taking that really concentrated approach helps. The third thing I would mention is, of course, patience. On a 6-month or even an annual view, this portfolio can absolutely underperform. But over that long run, we think about this with a 5 to 10 year investment horizon. We feel very, very confident in its prospects. So, absolutely we think that impact can deliver outperformance for clients. it's really important that we as active stock pickers are also very discerning about the types of companies that we pick. So yes, we're looking for impactful companies, but they also must have a durable competitive advantage, a great growth opportunity, a strong management team, all of those classic fundamental characteristics that we'd be looking for from any growth company. So if we're discerning, if we have that really focused view of impact, we have a concentrated portfolio and we're patient, then we think those are the ingredients for that long-term outperformance. Yeah, so this is an interesting question because historically, this was the preserve of quite sort of niche private equity or alternative asset classes, and impact remains, I think, done really well through a range of asset classes. But we feel really passionately it can and should also be delivered through listed equities. And why is that? Well, first of all, we are patiently backing companies with our capital. And that's really important, particularly for younger companies that may see short-term share price pressure as they're investing for the future. Being there and providing that sort of patient shareholder base is really important. And actually, there's lots of evidence that shows that having a patient, active shareholder base does help a company's long-term prospects of outperformance. Most of the capital that we provide is obviously secondary, so we're trading with other people on the market, but we do provide primary capital at scale. So for example, we've invested recently in Baillie to 1, which is providing game-changing, much less invasive prenatal tests. Also, engagement is obviously critical. So we engage deeply, again, patiently and over the long term with many of the companies in our portfolio. And as a result of taking the time to develop those relationships and support what are generally fantastic management teams, we can also wield real influence where we're looking for companies to improve. So engagement is a critical aspect of it. But look, I would also say that it's really important to us, and one of the reasons that we set up the Positive Change portfolio is we wanted to democratize access to impact. We wanted this to be an accessible asset class for all. We wanted everybody to be able to invest their, hopefully long-term savings in a manner that not just delivers outperformance, but does something good for the world at the same time. And listed equities is obviously a wonderfully accessible, relatively good value, and highly liquid asset class. So we feel really passionately that there is a place for listed equity impact strategies in any portfolio for a long-term saver.